In the previous video, we talked about exchange rates. And exchange rates are just the price of one currency in terms of another. Now, there are a couple of ways to quote exchange rates. You can use direct quote, which means that you're asking yourself, how much of the domestic currency does it take to buy a unit of the foreign currency? You can also use indirect quote, which says, how much of the foreign currency does it take to buy one unit of the domestic currency? And as we noted before, whether you're using an indirect or direct quote depends on which is the foreign country to you. If you're in the United States, pound sterling is the foreign currency and US dollars is the domestic currency. But if you're in Great Britain, pound sterling is the domestic currency and US dollars is the foreign currency. So to get an understanding of exchange rates, you can essentially look at a market for exchange rates, for demand for dollars or demand for euros. In this case, I happen to have a little graph here of supply and demand for the dollar market. And down here I have on the x-axis, I have the quantity of dollars. And on the y-axis, I have the exchange rate, which is using an indirect quote. It's how many euros does it take to buy one US dollar. And what we want to do is we want to understand how or why exchange rates change. And exchange rates can change because of changes in supply or changes in demand. In this tutorial, I'm just going to talk about changes in demand. So you can see that when the demand shifts out, it shifts to the right, price goes up, and that's true of anything. When the demand for a product goes up, the price goes up, and we see that all the time. When certain events become popular, perhaps a concert ticket, if a band becomes very popular, when they weren't popular at all, you could buy their tickets to their concert quite inexpensively. But when they become very popular, demand increases and the price for the tickets goes up. It's the same thing here. Okay? If the demand for dollars increases, so we go from this yellow demand curve, D1, out to this blue demand curve, D2, the exchange rate goes up. That is, it takes more euros to buy one US dollar. All right, so let's just note that. If demand goes up, demand for dollars increases, what happens? The dollar gets stronger. That is, it takes more euros to buy one US dollar. And I noted that in the previous video that a stronger dollar means it's cheaper for a US citizen to travel in Europe using euros. Okay, price goes down. Okay, it's cheaper to buy imports from a country that's selling in euros. On the other hand, it's also more expensive for a European to buy American goods. So sometimes you'll hear this argument from companies that do a lot of exporting in the U.S. that the dollar is too strong, that's why nobody is buying our cars or buying our goods. They're too expensive. Now, what causes demand to go up? Well, interest rates are one thing that cause the demand to go up. If the domestic interest rate, and I'm going to note that by ID, goes up, demand for dollars goes up. Why? Well, think about it. If you're an investor and you have the choice of investing in euros, okay, you're in Europe and you can invest in some bank in a country that uses euros, and the interest rate in the U.S. goes up, what's going to happen? Well, it's going to be better for you to invest in the United States. That means that those investors, those European investors, are going to have to buy dollars. The demand for dollars goes up, the demand for dollars goes up, and the exchange rate goes up. That is, the number of euros it takes to buy one US dollar increases. So the dollar gets stronger. Okay. Likewise, if the domestic interest rate, and by domestic I mean the U.S. interest rate, if the foreign interest rate, okay, the interest rate in Europe, so I'm looking at this from the perspective of a U.S. citizen, and I'll call this IF, if it goes down, the demand for dollars also goes up, right? If interest rates are very low in Europe, what are you going to do? You're going to look for a better place to invest your money, and that place may be the United States, in which case you can't invest your euros in a U.S. bank. You're going to have to convert your euros to dollars. That increases the demand for dollars, and that increasing the demand for dollars causes the dollar to strengthen. Okay, the reverse is also true. Okay, I haven't drawn it here, but if the U.S. interest rate went down, that would shift the demand curve back, and that would cause the dollar to weaken. In fact, oftentimes one of the problems that the Federal Reserve has in the United States is they're trying to maintain stable exchange rates, they're trying to maintain a stable price level, and they're also trying to promote economic growth. When they lower interest rates in the United States, what happens? It stimulates the economy. Okay, mortgage interest rates go down, which makes buying a home cheaper. Interest rates go down, which makes it cheaper for corporations to borrow money and expand their business. But it also causes the dollar to get weaker, which makes our exports cheaper, but makes things that we want to import more expensive. So this is one of the problems. I mean, if you want more economic growth in the United States, you may have to settle for a weaker dollar. That is the case where it takes less euros to buy one US dollar. So in terms of understanding the markets, think about why exchange rates change by thinking about supply and demand. What factors would affect demand? If Europe became politically unstable and people were afraid to invest their money in Europe, what might they do? They might convert their euros to US dollars where they feel it's safer. That would increase the demand for dollars, and the dollar would strengthen. So much of this analysis can be done by looking at simple supply and demand graphs to understand what happens to exchange rates.